Amazon stock getting crushed after reporting their third quarter earnings. At one point, the stock was down 20% after hours. The question is, why is Amazon getting slaughtered, and where does Amazon stock go from here? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand exactly what's going on here. Well, the reality is their numbers at first glance weren't that bad. I mean, you're looking at some companies getting absolutely slaughtered this earnings week for reporting, earning or revenue declines or sales that are flat. They're posting 15% revenue growth, and that does include a $5 billion unfavorable impact from foreign currency. Overall, when you add that back, their revenue would have increased 19%. So overall, very solid, I'd say, top line. You're talking about three different segments. North America segment, that's 20% growth year over year. International declined about 5% when you factor in foreign currency. Once again, positive 12. So really not that bad. It's really the strength of the US dollar that's sort of holding back these results. And Amazon's AWS, that increased 27%. And this is really one of the gems of the business, arguably generating most of the value for them, growing at hyper speed. Now, I think part of the reason why it's down and why people are like, hey, what's going on, is the fact that their operating profits continue to drop, down 48% year over year. So they're still investing heavily in their business. And worse, their free cash flow, which, keep in mind, their long-term goal, this company's been around for a couple of decades now, their long-term goal is to optimize free cash flows, and they're still not doing it. And so shareholders might be saying, hey man, how long does it take to get a proper free cash flow going on here? And I think folks clearly, it's still $1 trillion company for now. Folks are still sort of saying, hey, we give you credit even if you're burning $30 billion over the last 12 months because we trust the investments you're making. Now, keep in mind that $30 billion still is a net benefit of around $18 billion from stock-based compensation. So if you paid those employees with cash as opposed to stock, then you're probably looking at a cash burn closer to $50 billion if that's what what they did. So $30 billion cash burn really is ugly. So the question is, okay, so are they going to right the ship? And why is the stock even getting hammered? Well, it's not only because their profits and cash flows are pretty ugly, but their guidance for the fourth quarter created a lot of uncertainty because they're saying, yeah, our total sales might only grow 2 to 8% in the fourth quarter. And that does include around 5% impact from foreign currency. So what they're really saying is, okay, so we might have single digits growth in the fourth quarter. And the reason why that's a problem is because, well, wait a second, isn't AWS growing, Amazon Web Services growing close to 30%? So if that, and it's grown at, like 32% year to date. So if that's growing at, around high 20s, 30% growth rate, does that potentially suggest that all your other sales are roughly flat? Could even potentially even decline depending on where you are in terms of that, net sales figure. And so that, I think, is part of the reason why Wall Street was like, oh my gosh, what is going on here? Like fourth quarter, this is really bad. And management had some commentary about this, talking about how the macroeconomic environment remains challenging, talking about broad scale inflation, heightened fuel prices, and rising energy costs that's impacting their sales growth as consumers assess their purchasing power. And they talk about how we saw moderating sales growth. So they're talking about leaning into the fourth quarter. You're seeing data that is worsening. That's moderating really means across many of our businesses, as well as the increased foreign currency headwinds. So you not only have the impact of the strong US dollar, but you're also seeing consumer weakness. And this is interesting because this is one of the first times we're actively seeing sort of call out of a weaker consumer. I mean, we've seen credit card data that's generally favorable. We've seen advertising data that's very mixed. You see interest-sensitive data that's suggesting, hey, that's tightening, but like travel's really strong. And, at least that's, how it is with the major advertising companies that I talked about this week. And so it's sort of looking at this thinking, is this suggesting a weaker consumer? And also, if you have a weaker consumer and you're already burning $30 billion, what's that mean for next year? So clearly taking actions to tighten our belt. Well, how much, that's a lot of belts, $30 billion worth. And I think another red flag, that sort of gets people alarmed is seeing how, once again, their crown jewel, AWS, their margins declined year over year. Now, still growing profitability on an absolute dollar basis, but their margins declined to around 26%, which management attributed to balancing the investments versus renegotiating pricing with long-term customer commitments. I think that's sort of code for, hey, we agreed to lower prices with some of our long-term clients to make sure they stay with us. And that is a little bit bothersome, especially when you see that, let's say, Microsoft and Google, they're growing their clouds at much higher rates. Now, for sure, like Google's much, much smaller than AWS, in terms of size and scale, and still it's a heck of an accomplishment for AWS to still be growing at such a fast rate, 30% in a $20 billion business. But it is something to think about when you see that sort of language of like, oh, you're having to push back on pricing, to keep your customers around. Maybe that's a suggestion that they could consider switching to, Microsoft Azure or something. They also talked about what's hurting their margins is effectively wage inflation and seeing higher energy costs, the higher energy for powering those servers. So this is, something to keep in mind, because when you have something that's hyper growth and this is their core profitability, they're all their North American international, which is bulk, sales, where you're talking about their first party sales and their effectively their platform sales. So generating, commissions and advertising revenue. So when you look at this, AWS is the really profitable one. Everything else isn't really profitable when you lump it all together. Isn't all super profitable. They hide it based on some of their investments. And so looking at this, it's sort of, man, when you see AWS margins contract, that's going to have an outsized impact on Amazon stock, because this is the crown jewel driving a lot of the value. And when you're burning $30 billion, do you even have the cash to keep doing that? Well, they have $59 billion in cash, but they also have $59 billion in debt. They also have nearly $70 billion in long-term lease liabilities. And arguably, for the cash flow cows, which Amazon really isn't, it periodically goes to, hey, we're generating free cash flow, to, hey, we're investing in the business. Like, I'd rather almost have a company that, spits off that free cash flow and can buy back stock, but, they're returning it to shareholders via investing in the business and generating, above average growth rates. But if you're burning 30 billion and you're only growing 5, 7, 8%, that's not going to cut it. Shareholders are going to say, well, wait a second, inflation's that high. You need to be returning that cash flow to me, or you need to be generating much, much better growth. And so that's what Amazon's going to need to prove in the next year. Like, hey, we're not burning cash and we're growing at a much better rate, I'd argue. But the question is, okay, so where does Amazon stock, AMZN stock, go from here? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Full disclosure, this is not financial advice. So thinking about Amazon, once again, they break it off into these 3 separate segments. They do provide a little more granular detail for what's driving it. So you have Amazon Web Services. That's really the main profits. Everything else is unprofitable. International, North America. That's partly because they don't give you enough detail. And that's what's always bothered me about Amazon is like, well, how much is your, let's say, your first party sales, where you own the inventory? What's your margins on that? How should we think about your prime revenue? How should we think about, your profit loss here? And it's just challenge. Like, they don't give you enough detail to really like, yeah, you have this fast growing advertising business where merchants are looking to advertise on your platform and you're generating commissions, but how lucrative is it? Because you're still generating a loss. So I assume it's super lucrative, but what are sort of the investments that you're making that are more than offsetting it? And at this point, shareholders want to see. And so I suspect, and I'm sure you suspect as well, like, look, it is an unrivaled value proposition. Ding, 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 the Unrivaled Investing channel. This is what I want to see. I want to have a company that's unrivaled, but I also want to have substantial free cash flow and real profits. And so shareholders might be wondering, well, wait a second, what's it take to actually generate real profits for these segments? How profitable could they be long term? I mean, it's been several decades. Shouldn't North America already be profitable, to a sizable tune? So it's questions like that. So let's think about the valuation, thinking about the different pieces. So AWS generating, let's say, around 80 billion plus in revenue this year. 5 years out, thinking about their profitability, around 30% profitability, thinking it grows 20 to 25%, annualized over the next 5 years, thinking about that it's effectively like a utility and that maybe it's worth 25 times. Maybe it's worth a little more, maybe a little less. It doesn't generate all that free cash flow because they're buying a lot of servers. So thinking maybe it generates currently around 20 billion in earnings, give or take, net of taxes, and that's going to grow over time. So thinking about what AWS alone is worth, and keep in mind, this is a hypothetical framework. Of course, Amazon stock price can go way higher, way lower, but just think about what AWS is worth today and what it'll be worth over the coming years. One could say that it's effectively worth the entirety of Amazon's current market cap. So Amazon's current market cap around $1 trillion. Maybe AWS is worth $1 trillion. Maybe AWS is worth closer to $2 trillion. So I'm sort of penciling out based on a range of what I think are reasonable assumptions, effectively saying it fully covers the current market cap to maybe there's effectively 80% upside just from AWS before you factor in any of their retail operations. So then the question is, okay, so you have this global retail base generating 400 plus billion in revenue. Maybe that gets to 500 billion over the next few years. What's that worth? I mean, and this is the part that's really, really difficult because you have all these moving pieces and you don't have the granularity on where the profits are because they're showing losses. They're showing, cash burn. And so this is part of the challenge of like, okay, so what's this 400, 500 billion worth? They're trying to expand a lot internationally. And so they're making the investments there, but domestic's also still, US is still unprofitable. Historically it bounced around. Sometimes it could be profitable. So if we think that, let's say it could be like a 5% profit margin long term, I definitely open to hearing your thoughts in the comments below. If you think 5% is low or 5% is high, if you think 5% long term, that's where it sort of gets valued at, then you're thinking, okay, $20 billion, 5%, let's say after tax profits. If you say that, then you're talking about 20, maybe 25 billion in profitability, depending on when you're talking this year, 5 years from now, thinking about it long term. If that's the case and you slap on, let's say, a 20 times multiple, for that, then you're talking about like $400, $500 billion value. So we have $1 trillion market cap for Amazon, then throw on, let's say 400, 500 billion for retail, and then 400, 500, maybe up to 700 billion for AWS. 1 trillion 500 billion for AWS. And so you're talking about maybe $2 trillion in value looking at these two pieces, unless there's a component that you're thinking is worth dramatically more. So I'm saying AWS, around now over the next 5 years worth, 1.5 trillion, and their global retail operations may be worth, half a trillion. So all in combined 2 trillion versus the $1 trillion market cap today. So really saying like, hey, maybe 100% upside. And so I view this as really helpful benchmark for investors to consider. Like Amazon, clearly one of the best companies in the world. And I think you can reasonably, conservatively pencil out that it should be worth double over the next 5 years. And so you're saying, hey, this is a satisfactory, ballpark figure, worth double ballpark, maybe. And keep in mind, stock price can go way higher, way lower, depending on execution. But I'm giving this framework for which you can say, hey, I think Amazon doubles from here over the next 5 years. And it seems pretty reasonable. Now, I don't think I'm looking to buy Amazon, even though it is an exceptional business, even though it is unrivaled, because I personally, with the stocks that I call out to my unrivaled investing subscribers, I'm generally looking for things where I can say, hey, I'm penciling out, 200, 300% upside, especially if we're facing a downturn. I'd really love to own, companies that have sort of that where it's easier for them to grow at higher rates. And arguably $1 trillion company, the recent collapse in the former FANG stocks, I think, is showing now that Facebook's Meta, it's all Mang stocks. Oh, Mang, my stocks are getting slaughtered. I think recently it's shown that, yeah, these $1 trillion companies, it's hard to hold that value. Now, partly that's because of, an economic downturn, but the start of an economic downturn. We haven't even really seen that yet in the numbers. And so I'm looking at this sort of saying, this is a really good hurdle that you should consider for any investments. Like, hey, I could buy this, or I could just own Amazon, which presumably doubles, over the next, 5 years, maybe 5-7 years, give or take. And so for me, I want to find things that are smaller. Maybe it's not $1 trillion company. Maybe it's a $10 billion company. Maybe it's a $100 billion company where it's easier to grow to, let's say, that $1 trillion valuation, or easier to grow from $10 billion to $100 billion. And you're going to say, hey, that's the 10x. Whereas this is more, I also just don't like owning companies that don't generate, that don't have that just copious amounts of free cash flow that can get returned to shareholders. That's my personal preference. The counter, the bull argument is like, Daniel, you're missing the big point, which is that they just keep finding these growth opportunities. So they should be investing that cash flow. I just, wonder if you're only growing single digits this next quarter, you shouldn't be burning 30 billion in free cash flow. That's the problem. So anywho, if you enjoyed this video talking about Amazon stock, why the stock has gotten hurt, and where do I think Amazon stock goes from here, please make a point of hitting that thumbs up, hit that subscribe button. Thank you for watching Unrivaled Investing.